Investors who are risk averse and who will equally want to have a regular income and who can only stomach the risks that is inherent in stock market investing could find corporate bonds quite attractive. When it comes to corporate bond investing, the return may be low actually, but that element of risk is reduced to an acceptable level. And that's why in this video I want to talk about the advantages, the benefits of investing in corporate bonds. Corporate bonds actually are issued by companies, listed companies in the exchange who will want to raise capital for expansion, for growth, as well as for acquisition, as the case may be. So a typical disadvantage is number. A typical advantage is number one, regular income. So corporate bonds provides regular income in form of interest or coupon payments that is quite appealing for investors who are seeking cash flow. That may not be able to stomach the level of risk obtainable in the stock market. So that regular income is sort of guaranteed. Number two is high yield. Corporate bonds generally offer higher yields compared to government bonds. So these bonds are issued by companies that have a level of financial stability. And some of them actually are not all that stable, but those who are not really stable financially, they offer what is called high yield bond or junk bonds. So junk bonds tend to pay a higher coupon rates, while bonds from stable companies, financially stable companies, don't really pay as much as what junk bonds offers. Number three is diversification. So adding corporate bonds to an investment portfolio enhances, diversification, stability, and it smoothens out returns. And not only that, it helps you to be able to cushion the impact of the level of volatility obtainable in the stock markets. So you could diversify away from stocks, and then by incorporating these particular investments that is relatively risk-free actually compared to traditional stock investments. Number four is capital appreciation potential. Corporate bonds, can appreciate in value if the issuing company financial situation improves, or if there's a decline in interest rates, then of course that will then automatically cause bond prices to go up. Usually, there's that inverse relationship between bonds and interest rates. The higher the interest rates, the lower the bond yield, and the lower the interest rate, the higher the bond yield. By so doing, there's that particular opportunity for a level of capital gains. Number five is variety of issuers. Variety of issuers here, you discover that investors can choose from a wide variety of corporate bonds issued by different companies from different industries, different sectors in the market. So allowing for a targeted exposure to a given sector of the investors' liking. You understand? So they have that wide range of choice you could make. But actually, most companies, most blue chip companies, issue a corporate bond. So you have that leeway of making a choice. You have that advantage of making a choice. You feel will be able to meet up with your investment aim and targets. Number six is credit ratings. And when it comes to credit rating, you discover that corporate bonds, come with a credit rating that gives investors a clear understanding of the capacity, the ability of the issuer to be able to pay back the money without that risk of default. So this can help investors make informed decision as regards to how risky the bond is. And these are the activities of rating agencies. They rate each bond, you know, each company bonds based on the capacity of the company to be able to pay both the interest and the capital as at when due. So financially stable companies are rated very high, and those that are not all that stable are rated, somewhat low. Number 7 is callability and convertible options. Some corporate bonds are callable, which allows the issuer to redeem the bond before the maturity date. For instance, now you have a bond of, let's say, a 5-year duration bond. The issuer may decide to recall the bond before the four year elapses. You understand? And so it could be redeemed. It's callable. So convertible bonds, give the option to convert the bond into equity, to convert the bond into stocks. In other words, depending on the prevailing profit expectation, the bondholder can decide to convert his bond into the stock of the issuing company. All things are being equal, as if the price of the company stocks is rising, and you do that, at a predetermined number of shares you could convert your bond into. These are determined in advance. And not only that, number 8 is inflation protection. High yield bonds can provide a hedge against inflation, as their yield may outpace a rate of inflation, maintaining or improving purchasing power over time. Whenever we decide to invest in any instrument, we should not forget the impact of inflation on the interest, on the yield of of those instruments. And so in a case where an instrument yield is able to outpace inflation, that is a very nice rewardable investment. And so in the case of corporate bonds, the yield you can get, all things being equal, should be able to outpace inflation. That if your buying power will not be compromised. Please like this video and subscribe to this channel. It will do me a ton